Today on the show, we have Jonathan DeYoe. Jonathan DeYoe is the best-selling author of Mindful Money, simple practices for reaching your financial goals and increasing your happiness dividend. I just love that wordplay there. He writes and speaks about the intersection between life and money. He has been investing for 40 years and has been a financial advisor for 25. He started his firm in 2001, and he is a believer in financial literacy, education, and advocate for the fiduciary standard. And I'm excited to talk about this because we tend to have a love-hate money relationship. We love money, but at the same time, we have so many mixed messages about money, and we carry this baggage with us. So I'm excited to have Jonathan on the show. Jonathan DeYoe, welcome to the show.
Thanks, Bert. I'm actually really excited to talk to you. It's been a while.
What's that?
So I'm glad.
Yeah. Well, you know what? And I was saying money is such a weird thing for most people because we need money, but we also have been told that, money is the root of all evil, which is not true, and that rich people are somehow bad, and, money is this, and, so we have all these mixed messages, and therefore I think, and you probably know this better than anybody, that's why so many of us are broke all the time. And I don't care whether you're making $100,000 a year or $100 million a year. There's a lot of people that no matter how much money they make, they're still broke.
Yeah. And it's not just that they're broke. Their brokenness or their wealth and their relationship with money, they're unhappy. It's not that you're broke. It's they're unhappy with whatever's going on. And you can have money and not have money, and you can be happy.
Yes. And I choose to have money and be happy.
Right. It's very weird. I've been going back and forth with my mom. And so I grew up with very little. One of my mom's senses in this, back and forth was, yeah, Jonathan, we were poor. We were poor. There was a car that she used to drive me to school in where the back doors were closed with a rope tying the two back doors together. So you couldn't open them. You had to climb through the window. So it was, and so my whole life, I wanted to have, and I wanted to build something, and I wanted to make something happen. I wanted to, wealth was something that was, somebody else's thing, and I wanted it. And it's like 3 years now, I'm 49. And for the last 3 years, I feel like I've finally been able to breathe. Still work really, really, really hard. I still, I still put in 10-hour days. I still work on Saturdays. So I've always had this desire to build something. And to support other people in their search for understanding of how money and life work together. It's always been this thing in the back of my mind. You said I invested for 40 years. I purchased my first stock when I was 9. And I've been looking at this stuff ever since. And it's really fun to me to think about markets and economies. And my clients say, hey, I'm glad it's fun for you because they hate it. So, it's a great symbiotic thing.
Well, you know what? And I think the reason that most people, quote, hate it, they don't understand it. They haven't devoted the time to understand it. If I don't care what it is, if they would invest the same amount of time to understanding money and their thoughts and feelings around money as they do to, let's say, their fitness or their core enterprise, they would have a different change. And I think that's why most people have this love-hate relationship with money, because they just don't understand. They don't understand money. They don't understand how it works. And they don't understand their relationship that they're having with money.
So I would be a little more charitable. I mean, okay. I think that's true. I think it's true. They don't. But I think they don't because they've actually pursued other things that are more interesting to them. There's a lot of people out there that say, hey, you can't do this yourself. You got to hire an advisor. And that's just not something I believe. I think that people can probably do this themselves. I think it's really important that if they do it themselves, that they spend the time. But people have a choice. They can take longer vacations. They can, work harder at the thing that they want to do the most. They can volunteer their time in their communities, at their churches, at their schools, at their, they can spend time in lots of different ways. And the one resource we can't renew is the time that we spend. Once you spend it, it's gone. So, I actually think people take a choice. They say, you know what, for this thing, I know that it's going to take me a lot to monitor and manage and think about and invest and line up the pieces so that I can have all those milestones and I have a retirement income. And you know what? I just don't want to spend that kind of time. And so I'm going to hire somebody else to support me in this role. And you can do this for anything. Like I can probably, and I did this when I was younger, I could bondo my own car after an accident, but I don't anymore. Right now, if I have an accident, I pay someone to fix the car. And I kind of look at us as a service industry. People pay us to help them in the process.
Right.
They could do it themselves. They could do the research. They don't want to, which fantastic. I get a great job and I do what I love and I get to help people. And that's it's great. We work together.
Yeah. Well, into that, I know like my personal experience, I wanted to understand it a little bit better. And so I started doing my own research and I subscribe to a couple of different newsletters from Motley Fool. I subscribed to a couple other things, and it can be overwhelming. It's I was putting in, I want to say, anywhere from 10 to 20 hours a week trying to figure this stuff out. And so yes, you can do it yourself. Yes, sometimes it's better to get professional help. And I think it's better to get professional help no matter what, because you'll save time. You can still do the research. I think it's good to understand how things work.
Right.
So you don't get taken, because there's a lot of confusion out there. And I think this is the other problem that a lot of us have. The amount of information or misinformation is overwhelming. There are a lot of different designations. There's the broker, there's a fiduciary, there's all these different things, and people think that they're kind of all the same, and they're not. And there's one of the things that kind of bothers me is and I, not to be disparaging to anybody in this field, but there's a lot of insurance agents that use financial advisor, and basically they sell insurance and annuities, which is another type of insurance, but they're allowed to call themselves financial advisors, and I'm thinking, not really.
So there's three rules. Like, this is the three rules. When you want to hire somebody, there's three things you need to do. And I always say this: the advisor you're going to hire, you're going to search for someone that's fee only. So that means they do not receive commissions from anybody, any product manufacturer, whether it's insurance or an investment product or anything. So the person that offers advice is paid for advice, not for a product. So that's rule number one, is fee only. Second rule is fiduciary. Fiduciary has to put your interests first. They if you are the lesser of the two options, you have to meet a suitability standard. What that means is, if I'm a broker and I only have to meet a suitability standard, and I think the S&P 500 is a great investment for you, I can sell you an S&P 500 mutual fund that has a 2% internal cost and gives me a big commission, instead of the S&P 500 index that costs 0.03% and I don't get any ongoing commission from, because it's suitable, right? So the fiduciary standard says, okay, S&P 500 is appropriate for you, so we're going to use this low cost 0.03% index. I'm not going to get anything from the product manufacturer at all. So rule number one, fee only. Rule number two, fiduciary. Rule number three, and this is kind of the personal one, right? This is the one you have to really dig into and get to know this person. You have to trust them. The advantage of an advisor is they're going to tell you when the thing you're about to do is a mistake. They're going to tell you not to do this, that maybe you should have this other action, take this other action. And so you have to be able to hear that, and it's got to modify your behavior. And nobody wants their behavior modified. So you have to trust them in such a way that when they say, hey, I think you ought to stay diversified, I don't think you ought to go to cash, or I think you ought to stay diversified, I don't think you ought to go all in on Bitcoin, or whatever the fad of the day is. When they say that, you believe them, and you can maintain the discipline of believing them and take the right action just because they said it, even though you don't agree or you don't feel good about it. Because feelings actually lead us to do some things, buy things we don't need, make investment decisions we don't want to make. So those are three simple rules, right? You got fee only, fiduciary, and you got a trust is the only other thing that matters.
Yeah. So I like that fee only, fiduciary, and of course trust, because ultimately trust is the most important thing. And I've had some people that I trusted, and you're right, they modified my behavior. So instead of maybe putting in the 100% that I was going to invest, maybe I said, okay, I trust you, so I'm going to do 50%. All right, I still want to risk, right?
Right. No. Right.
Yep. But that's me. That's my inherent. That's me because I'm a risk taker, and I also believe that where I'm at in life, for me personally, I'm going to have to take some risk to make up for some stuff that I've lost in the past.
Well, there's nothing wrong with taking risk. I mean, I'm 100% equities. Like I believe in equities, but there's a right way to do that. There's a right way to take that risk, right? Yeah, I'm not 100% in one equity. Like,
right.
I'm very globally diversified. I'm diversified across capitalizations, across industries, so I'm invested in everything. It's risky, it's volatile, it goes up and down a lot. But there's a right way to be risky. And so if somebody comes and says, I want to be really risky, there is a way to build that portfolio for them, right? So it's not always, be conservative. It's not always, it's very plan appropriate. We talk about goal focused and plan driven portfolios, goal focused, plan driven. And so, you build a portfolio that's specific to the client. The client has hopes and dreams and needs that need to be fulfilled. You build that stuff to support that lifestyle choice, those goals that they have.
Yeah, absolutely. All right. So let me ask you this.
Sure.
Right now, we have, speaking of volatility, we have a weird market. And in my opinion, the market is being propped up, I don't know, by funny money or something. I think the market should be a lot cheaper than it is. But I want to get your take, putting COVID into, let's say, a long-term context for a family's finance. Are you recommending any specific action for people to take right now?
So I think it's very interesting because I was thinking about this morning. Right now, markets are up for the year, right? So they were horrible. Like it was, it completely fell apart. But when you look at a long-term chart, 5 years from now, this will literally have been a blip. It will have dipped and come back. We've now had the fastest, 40-something% gain in the S&P in history. It's come back so quickly, and usually this kind of recoveries take a couple years, right? But this took less than 100 days. So what do you do with that? Like, what's the advice around that? Well, there are three sort of golden rule, always on pieces of advice when we're working with people. And the first is, plan appropriate asset allocation. So if you were in a plan appropriate portfolio, an asset allocation that reflected your plan and reflected your tolerance of risk and reflected your capacity for risk, then when the markets went down 30% in 20 days, that happens. Like that, we expect that. So if you were in a plan appropriate portfolio, you rode that out. You didn't change a thing. You might have rebalanced, and that's what we would have advised, and that's what we did in late March. But we did the rebalance, and now we're back to even, and we're actually ahead now. So that's the first thing, is that plan appropriate. The second thing is always broad diversification. Don't fall in love with anything. Don't fall in love with Apple here or Facebook or whatever they're talking about today, Bitcoin. Don't fall in love with these things. They're very attractive. They're always attractive at market highs. That's when all the media attention goes to the thing that's doing really, really well. And then everyone chases that thing. And then the third thing is, and this is an always behavior, regular rebalancing. And we're not talking because it goes up or down. We're talking about, because it's January 1st and this is when you rebalance. And by doing that and pursuing those three things, plan appropriate asset allocation, broad diversification, and regular rebalancing, you actually pull ahead of most other investors. Now, in March, there were some things to do. When the market was down, it's not down anymore, right? It's already recovered. But in March, there are four things that we talk about a lot. The first is we do some opportunistic rebalancing. And in March, I think it was March 23rd, we did some opportunistic rebalancing. We sold we sold some fixed income and we bought stocks. Not at the bottom. I'm never perfect with that, but when it goes down 20%, we do a rebalance. Second thing is we did tax loss harvesting, right? So we want to set ourselves up to pay lower tax over time. So when we get the opportunity, we harvest some losses to pair against future gains. Sometimes, if you're quick about it, you had to be really quick about it in March, you might do a Roth conversion. That's a really good way to take advantage of a declining market. And then right now, the only thing that still exists in this whole system of things that you do when markets are volatile is markets get volatile, and then the Fed pumps a bunch of money into things and rates go down, 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 down. And so you refinance as much debt as you can. And that right now, that's the number one thing you can do. You can save hundreds, maybe thousands of dollars a month by refinancing old debt, whether it's on a rental property, if you got a car that you borrowed, if it's on your house, whatever the thing you're borrowing for, look at refinancing that debt right now.
Yeah, I think that's a fantastic idea. That to me is something that everybody can do. It's not that complicated, and what a great use of that. I love that. Absolutely correct. And matter of fact, I was reading an article, I can't remember on what, but two major brokerage houses are now coming out with a 2% mortgage.
Oh, my mortgage, I refinanced, the last time I refinanced was 2017, and I got a 2.65% 15-year mortgage. And I'm talking to my mortgage broker right now, and she said last week, Jonathan, we can get you 2.125, but I think if we wait a week, we'll get 2 on a 15-year mortgage. And I'm just like, you know what? Let's get sub 2. I'm going for 1.97. I'm going for just under 2. Okay, for bragging rights, which is greedy and stupid. Don't do that. Like if you're going to refinance now, refinance now.
All right, so I want to ask you this, because something that you brought up a little while ago, and so I want to ask you, what do you mean by goal focused and plan driven? Talk about this.
So the problem with investing in our culture is that we are focused and performance driven. It's a problem because neither the market nor performance can ever be predicted or managed in any way. Nobody has any idea what future relative performance is going to be. There's a lot of research that tells us that many people try to do this, but most of them fail. So those few who succeed are lucky, not skillful. So there's a better way, and we refer to that way as goal-focused and planning-driven. The first step really in a goal-focused, planning-driven process is to understand your values and the trade-offs you're willing to make or need to make so that the priorities in your financial life can become your future reality. So this is a fancy way of saying you got to do some financial planning, right? You got to plan for your future. If you do not plan, then you will buy the thing, and that purchase of the thing will be money that you could have saved to send your kids to college or use as a retirement income, right? So by having a plan, you know what your goals are. You can focus on your goals over these other things that may not make you happy, that may not bring you fulfillment, that may not be things that you're committed to for your life or for your kids or for your family. So the goal is always better investment outcomes. And the path to better investment outcomes usually starts with knowing what you're saving for. And so you can put more to work. And so, the whole idea of goal focused and planning driven is nobody can predict. So we have to plan, and we just have to commit a percentage to equities and just hold that, rebalance occasionally. We're not trying to outguess things. The thing we get into is we're always predicting. Like you just brought this up, right? With all the stuff the Fed's doing, I feel like the market should be down. That's a prediction. Like the market is reflecting everyone's predictions all the time. So right now, more people are predicting that the thing is going to go up from here. And, in March, everyone took off. All the analysts said, they threw their hands up. They're like, I don't know what earnings are going to be like in 2020, 2021, and I'm not even sure what they're going to be like in 2022. So they took off all their estimates. And in the last month, the estimates are all coming back. And the estimates are actually surprising. 2021, The estimates, again, there's no proof that they're accurate, right? But the estimates are that 2021 is going to look a lot like 2019, right? So companies did what they're supposed to do in this kind of environment. And it's very difficult to manage a company in this environment, but they're managing the companies in this environment. So, that doesn't change. They're always going to manage these companies. You have to kind of trust that happens and just commit to equities and stick with that commitment. That's right. Emotional, not intellectual.
You know what? And I like that. Well, and I'm a big believer that everything is emotional. Even, people who say, hey, I'm very logical. Well, yeah. That's an emotion. You're logic. You've sat there and you've gone through a process to weed out as much risk as possible. And so now you feel comfortable moving in or moving out or whatever, whatever you make that decision. I like what you said there about, again, having a plan and sticking to it. What's interesting to me is several times I remember buying my first house, and I've seen this with first-time home buyers, that when they're getting ready to buy a house, they are very committed, and so they don't, they're paying down debt, or they're not creating any more debt, right? Everything's got to, you have that short window where everything's got to stay the same financially, otherwise it could ruin your chances of getting the mortgage, right?
Yep.
And so they don't make any big expenditures. They're paying down debt. They're committed and sticking to that plan. Of course, now they get the house, and now everything goes out the window because they've reached their goal. But that's kind of what it reminded me of listening to you, is that we can do it. We all do it to some extent. Maybe we start saving money for that new car, or again, as I mentioned, the house or the vacation. And so because we have this emotional commitment to reach this goal, we start saving and not being distracted by the next shiny object, even when it's, Black Friday, and the sale, the TV that you have your eyes on is like 50% off. You're not enticed by that because it's not gonna, it's not part of your plan. It doesn't distract you because you're so focused and committed. And this is where I think a financial advisor is helpful, because you're a coach and you can say, hey, Bert, based on what you and I've talked about, this is what you need to be doing, or let's not make that investment or that purchase based on what we've talked about and what we have planned out. Yeah. And this is where I think that thing that where you talked about having a coach that you trust, or a financial advisor that you trust, that you can bounce ideas off of and keep you on track.
So my crusade is actually, it's not so much go find a financial advisor, it's have a financial plan. Because we look at, and I don't know how many people meditate, but the reason the book is called Mindful Money is because I've meditated for 25 years. And I actually think that what mindfulness gives us is it gives us a space between something happening in the world, or a desire happening in our heart for this thing, that's, the shiny object, and the decision that we're going to pursue that. So the space between the thing that happens and our pursuit is a chance to, if you're meditating, you get distracted and you bring yourself back to your breath, right? So if you have a financial plan and you get distracted by something that's a financial cost right now, then you need to bring your mind back to the plan, right? The idea is you have an anchor point. And there are many, 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 many people that it's really easy to create a plan. I mean, if you go through the exercises at the end of the chapter, every chapter in my book, at the end of the book, you have a plan. It's rough, it's rudimentary, it's not all integrated, but you have a plan of action, you have a plan. And if you have a plan, you know what you're supposed to do. Now, sometimes it's hard to do the thing you're supposed to do. Like, we all know we're not supposed to have ice cream, we're not supposed to eat steak every night. But many of us do. And so when we have too much ice cream or too much steak, our health goes down. There's a gap between what we know and what we do. And that's where that coach comes in. If you know that you're not the kind of person that can stick with your plan, then you've got to get a coach. You've got to get someone in there to help you, to hold you accountable to your plan. But if you can stick to the plan, you don't need a coach. And Vanguard did a study on this, and Vanguard says fully half the benefit an advisor provides is holding you accountable and keeping you on your plan. It's saying to you, when that you get that there's this great deal on a boat, it's saying to you, hey, the boat's not part of your plan. If you can have the boat, but then we have to figure out what you have to give up in your plan to have the boat, or the vacation home, or the 6-month vacation, or the, whatever it is. It's a matter of understanding your trade-offs and sticking with those trade-offs. And if you don't get pulled off the trade-offs that you've been willing to make, the things you've decided you don't need to be happy, if you're willing to pass on those things, then you get to have the things that'll make you happy. But if every time something comes along that'd be a nice to have or neat, it's a want, and you pursue it, you're going to lose the things you want to have. And the things that not everybody, but most people think about when they think about planning is they're thinking about retirement income. They're thinking about maybe taking care of their parents when their parents are older, if they haven't planned very well. They're thinking about their kids in college. They're thinking about lifestyle. So they're thinking about maybe a couple week vacation a year, maybe. And then they're thinking about, if they're really good, if they're really lucky, at the end of their life, they maybe will leave some kind of legacy for their kids, or, for their alma mater or church, or whatever their things that are important to them. So there's 5 main buckets that people really plan for. And then everything else becomes it's a nice to have. And I don't know, maybe there's a 6th thing, maybe there's a 7th thing that people would plan for. But if you just buy stuff, then you aren't thinking about the big picture, then the person you are today is the only person you're caring about. It's the only person you're taking care of. You're not thinking about the person you're going to be in 20 years and what they might want. And there's a lot of people that, would say, no, I'm just gonna live for today, live for today, live for today. I hear that all the time. I spend a lot of time studying Buddhism. I understand now. I get that, right? But I feel a lot better about my now, knowing that I'm okay and my kids are okay and my wife's gonna be okay. If something happens to me now, they're okay, right? So I get a lot of oomph, a lot of feeling of I fulfilled my responsibilities on the planet, knowing that I am saving for the future. I feel better now, knowing that I'm setting aside for that next thing that might happen.
Absolutely. There is an incredible amount of peace when you have those things taken care of.
Totally. That's what it's about. It's about creating contentment.
Yes.
Peace. I mean, your plan should start with your values. What's important to you. That's the ground. That's the grounding. And then when it's, when something's distracting, you get the squirrel or the shiny object, whatever that thing is that pulls you away. You go, wait a second. That's actually not important to me.
Right.
I traded that off. I don't have to think about that. And it eases your sense of, anxiety about everything to know, oh, I don't have to pay attention to that. This is why meditation is so important, because when you meditate, that's the practice. The practice is something rises in your brain and you let it go. Like when you do the bench press, what are you doing? You're practicing with those muscles. You're strengthening those muscles. When you're meditating, you're strengthening I don't have to think about this muscles, which is, oh my God, it's so calming.
Absolutely. Absolutely. And also we, when I say we, society, and this goes back to your mindfulness, your meditation, we get hung up on sometimes trying to make other people happy. For example, Christmas is a big pressure cooker for a lot of people. Hanukkah is a big pressure cooker for a lot of people. And, the reality is, especially if you have young kids, you can go into debt trying to make the perfect Christmas, and they're going to be excited for a millisecond. Yeah. And depending on how young your kids are, they may enjoy playing with the boxes more than with the toys. But I can remember a few gifts that I've gotten for Christmas, but I want to say that, except for maybe, again, for a very select few presents that I've gotten for Christmas, most of them are gone.
Yeah.
And all the hard work that my wife and my kids took the time to get me this present, which is very grateful for. But my point being is, sometimes we stress so much that we forget that some of the stuff isn't really that important. It's going to come and go. And at the end of the day, your kids are going to be more grateful that they're not going to lose their house, that even though mom and everybody is sad, they're, at least financially, they're not going to be stressed. That's that's the best gift you can give anybody.
So I was thinking about this the other day, and I'm probably bucking a whole bunch of research on this topic, and I'm speaking out of school. I don't really know what I'm talking about, but I want to. This is the thought process I had, and then I'm going to tie it back to personal finance. So I've read probably 20, 30 articles about how bad this COVID, don't go to school thing is for kids, because it takes away their ability to do this and this and this and something. And I'm sure that's all true and accurate, but it's actually giving them something else. It's giving them coping mechanisms. It's forcing them to figure out a way to manage emotions that no one should have to manage. And so I say that, and I'm going to tie this back to that Christmas analogy you just offered up, because I mean, I grew up and our Christmases were, I got a sleeve of Girl Scout cookies, the Thin Mints. My brother got the other sleeve, and I got, socks and underwear, and I got a toy. And that was it. And so I didn't have these huge expectations, but then I spoke to my friends and I was like, holy cow, you got a computer and a bike and a compound bow, and you got all these things. And I'm like, wow, what? So I wanted, but I didn't get. And so I had to deal with not getting. Now my kids, my mom, their grandma is, let's say, generous around the holidays. The toys and things. So we get them a few things, and then grandma goes crazy. So they just have a smorgasbord of stuff that they get every holiday. And my wife and I go, what are we teaching them? Like, what? They don't, and I just don't think that giving people everything, I think it robs them of lessons. I think it robs them of other things that are equally valuable, probably more valuable long-term. So we make a big deal about we as a culture make a big deal about giving lots of things and making sure the kids have great, holidays. But I actually think the kids that struggle and don't get everything given to them, I think that they get a valuable life lesson. And the thing I worry about with my own kids, I was raised with very, very little. That drove me to actually, do good in school and work really, really hard. And my kids are great, right? They're very well adjusted. They're great, but they're given a lot. They have a lot more opportunity than I ever had. And do they take that for granted a little? Probably.
Sure. Yeah. They're supposed to. Well, you know what? I tell you, your Christmas story reminds me of a family that I saw on Oprah Winfrey many, many years ago. And so it was I believe it was 5 or 6 kids, and all they got for Christmas every year was like an apple, an orange, a few nuts, and I think maybe if they were lucky, socks and underwear. That was their Christmas.
Yep.
Now, each of these kids, they were either professors at an Ivy League school. Yep. They were lawyers, doctors, and they all had attended prestigious schools. Yep. So if so possibly one of the lessons, and this is what you're trying to bring home, is that we get so much out of that struggle, because if these 5 kids would have been given, as like most of our kids are given so much, their motivation is killed. So maybe we can, give our kids less, and maybe they become more rounded and more motivated. Maybe they get more stuff done. Yeah, it's so difficult because that competition exists. I have 2 kids. I'm in the middle of this process myself. So, Kate, my wife, and I, we talk and we're like, but their friends all have this and that and this other thing, and they're in a school where it's they're surrounded by. I mean, I'm in Berkeley, California, so there is a lot of money here in the Bay Area, and there are. I mean, people wash their cars every week. It blows my mind a little bit. I grew up in South Dakota. You wash your car once every 4 years, right? And that's only if you can't see out the window. What you do is you just wipe out the back window. You don't have to wash it. Right. Anyway, so that's a digression. So the kids and their peers, they have everything. Yes. And so then, you don't want to be that cruel, mean parent. And that's what they tell you. Dad, you're so mean. And you're like, but that's about you. That's not about them. And so how do you make it better for them?
don't give them so much.
Don't give them so much.
It's such a hard thing.
Give them an iPhone that's 2 years old.
We actually made them buy their own iPhone. That's what we did.
We did too. So, my wife and I, we bought them these cheapy phones from Walmart. And we have 2 young kids. They were 15 at the time when we did this. They're twins. And they came back and say, we're the only people that don't have iPhones.
Yep.
I said, honey, that's rough. You have a phone, you can text and you can call. That's all we need you to do.
But I have to hit three times to get a C in my text. It takes me forever to respond.
Well, but each of them bought their own iPhones.
Yeah.
Yep. And they had to save for that money. And the best part is, because they were 15, luckily a friend of ours has a dog grooming shop, and she hired them on the weekends. And this is nasty work for girls, for anybody to do, much less girls. But they learned so much from that. They saved their money. They learned a new skill, and they were covered with hair and pee and sometimes poop. Oh. And it's just a blessing, because most people don't get to experience that every day.
Yeah. So there are areas where we're pretty lax, and there's other areas where we're very strict. But both my son and my daughter started working when they were, I think Eli started working when he was 12. And so we have a neighborhood pool. Someone's got to sweep the pool and take out the garbage and clean things up and those kinds of things. And so they both did that job. And now he's 15. He's gone on to, he's working at a deli. And so he's busting tables, and he's working in this period. And that was we had a big question if that made a lot of sense. That's a risk factor, having to go out in the world, and people, he's handing people food, and what if they sneeze, and what if they have COVID, and there's all these kinds of things. But it's such a huge lesson. And he's earning money, and he's saving, and he's almost 16. California, you can drive when you're 16. So he's thinking about, I want to get a car, which is, having that goal that he has and making him work for it is, I think there's something really important about having a goal and working for it. It works for 15-year-olds. I think it works for 40-year-olds, 50-year-olds. I think, if you get to 50, you haven't saved enough, boy, you start thinking about retirement, people start saving a lot if they haven't saved by the time they're 50. Absolutely.
Hey, we're out of time, Jonathan. It's been a blast having you on the show. I want to plug the book one more time. It's Mindful Money: Simple Practices for Reaching Your Financial Goals and Increasing Your Happiness Dividend. I love that. Increasing Your Happiness Dividend. Available at mindful.money. Mindful.money is the website, or Amazon. You can check it out there. Jonathan, looking forward to have you back again, my friend.
Thanks, Bert. This has been great.
Absolutely.